Hello, everyone. Welcome to another episode of Lunch Tech in Chat. And I've got my friend Will here. Today, apparently, is a holiday in parts of Australia. Can you explain that story, Will?
Yeah, so I just found out. So it's the first year in Australia, and I was just talking to my wife, and she said that they have a holiday for the day before the end of the AFL. For those that actually don't know, the grand final of the AFL. But for those that actually don't, AFL is a Australian football league, so it's Australian football. Like, look, it's actually a very look up for those that haven't heard of the name. It's a very interesting sport. It's mostly all played professional. If I'm not mistaken, actually in Australia, there's a few semi-professional leagues outside the country, but especially here in Victoria, which is in the south of Australia, people are absolutely crazy about the sport. It's like we've been to some of the stadiums here, a few matches. They put 100,000 people, kind of like screaming, like absolutely going nuts.
Wow.
And it's actually a very interesting sport. Like we learned to even follow ourselves in like the last half a year. Is a mix between. It's kind of like a mix between football, like soccer, and rugby. So it's kind of like it's it's not as brutal as rugby, and is not like soccer in the sense that like the ball is still kind of like being passed to each other, kind of like hands and feet. But it's very interesting. It's very tactical sport. It's people here
Right.
absolutely loved it, and they
And,
actually created a public holiday. Is every year the public holiday because final.
and talking about that, I'm going to see the All Blacks on Saturday.
Awesome. Yeah.
All right. So let's talk about Will and I, just before this call, we were just talking about, banking, blockchain, DeFi, AI, sort of all these financial um, institutions and how blockchain and AI are sort of touching them and what the future is starting to look at. So if we go back in time, like crypto started, I don't know, like 10, 20 years ago. How long ago now um, since we had Bitcoin? It was a long time, eh?
The origins of crypto, the very first kind of like the principles of having kind of like known kind of like cryptographically um systems where there was no counterparty in the middle, they date all the way back to the middle of the 90s.
Okay, but
So
let's talk about Bitcoin.
but
When did Bitcoin come along?
2009.
2009. So since
Yeah, yeah.
2009, this thing has been growing. Everyone has been talking about, tokens and blockchain and the technology and stable coins and meme coins and all those names that we keep hearing. And Will is like completely embedded, like he live, breathe, eat, and drink blockchain and DeFi every day, and he understands this world a lot. And he's been in a lot of involved in a lot of stable coins and tokenizations and a lot of projects, and he has a lot to talk about. And I think it's really interesting to start thinking about like DeFi is growing really, really fast. DeFi is taking the market. There's a lot of stuff that is happening. You're seeing billions of dollars starting to get more and more. We're seeing like Donald Trump talking about it, all his family investing in stuff like that. And you're seeing like
Some
the
known
big
dodgy
companies.
stuff going on, right? So
A lot of dodgy stuff as well. A lot of dodgy stuff, like the stuff with Milei in Argentina. And you see like those massive companies in New York and, the Wall Street now getting more and more interest. You see companies like, what was the antivirus company that bought a lot of Bitcoin and now they like a investment company, what they called again?
not antivirus, like the one that was used to do like the BI services, MicroStrategy.
Yeah, MicroStrategy. So there's lots of crazy stuff that is happening. And banking is something that has like existed almost forever, right? Like banking is just part of everyone's life. Nobody talks about that anymore. It's just embedded. It's part of every country and every society. And this is where some of that disruption is coming now. So I want to hear from you, Will, like, what are you seeing? What is happening? What's the trend? And what should people in banking be looking for?
Yeah, so I guess when I think it's probably kind of like important just like to differentiate kind of like different types of banking, because the banking industry itself, it's probably it's an interesting, like what you said, like banking is in everything. I think from my perspective, banking reflects actually how people like banking reflects how people interact with each other. Like we interact with each other through things that we give priority, things that we love, things that we don't love, things that we hate. And all of those, I guess, human characteristics on how we kind of like we transact with each other are reflected in banking. So banking is as almost as complex as the network of relationships that exist between different people, right? And it has been like this ever since the old days when we've evolved from essentially barter, like barter, which is essentially kind of like I have a cow, you have a banana, and you are trying to trade with me. Like I want some of your banana, you want actually some of my meat, and we have to define how much of your banana actually against.
I'm not killing my cow. That's long-term investment. I only sell cheese and butter.
Or maybe actually just cheese and butter. It's probably actually a better thing. So, and all of that intermediation that exists eventually evolved towards a means that could be understood by anyone. And instead of I want bananas and I only have to find someone that actually sells me banana, I can just sell my milk and then be able to utilize the proceeds of that selling actually to purchase whatever actually I want. And that's when, at that point in time, I mean, I'm oversimplifying, money was created, right? And through different forms, money conceptually was actually created, right? In over, if we could get a little bit like more into the present, doing a whole history of money, and we talk more like about banking. Banking in the last 100 years mostly has been evolving technologically, right? It has been always kind of like changing in shape or form. I mean, if you think about like, for example, things like investment, like I used to when I wanted actually to have, for example, ownership of a company or ownership of a piece of a debt instrument from a government, like a bond, I used actually to have like a paper representation of it. I had actually to go to an office, actually get access to a paper representation of it. Over time, those things actually got, adopted new technologies. Already, you can already imagine that relative to you selling your milk from your cow to actually having a paper that actually kind of gives, this is the faith of government, and therefore you can collect your your
Excellent.
you can collect, yeah, exactly, and this is going to pay you back. There's already an evolution. It was actually using the technology of paper, right? And then it over time kind of like evolved towards something a little bit more, I guess, technological, and especially over the last 50 years with the advent of computers and things like this. Banks have adapted actually to all of that, and the industry has shifted. And every single moment of evolution, those that were in the business of banking, generally speaking, from investment, from lending, from hedging, from trading foreign currencies, etc. Those that were in the business of banking that evolved, they stayed alongside the evolution of banking. Those that actually didn't evolve don't exist anymore. So, for example, a lot of the early issuers of those bonds, like railroad kind of like companies, like back in the late 1900s, most of them actually don't exist anymore. One, because actually a lot of countries don't have like railroads that are used anymore because of like the advent of cars. But second, because they actually didn't necessarily learn how to adapt themselves over time, right? So, and it's the same thing with banking. Every single innovation in banking have companies that actually adopt the innovation, and have those that actually don't adopt the innovation. Those that don't adopt innovation and tend to eventually fade away, because the market, the individuals, they start seeing the value of the new generation of the evolution of banking. And this is not different to other pieces of technology, but it's very, very important in banking, because it reflects all of those the interactions of network and relationships we have between individuals. If individuals and households and corporates, they have a preference for a particular type, eventually their preference is reflected into the value of those that actually serve that plumbing, right? But it's a complex plumbing.
I was
And
just gonna say, like banking, you probably like the start of banking was all about money, right? Like you've got a piece of paper that now it's understood to have some value, and that piece of paper needs to be stored somewhere so it's secure. But then it evolved not just the technology, but the services as well. So banks today have like thousands of different services, and they keep evolving the services as society grows and changes. But now we have like a big shift of, the whole technology behind moving really fast in the world of DeFi, coming with new services that banking is sort of taking longer to adapt, right? And I think that's the really important like core of this that I would like to unpack. Like, what are you seeing as what is DeFi for you, and how does that differ from traditional banking?
yeah, so first of all, I like, relative to the size of banking and relative to the size of finance, let's not necessarily kind of like overstate that DeFi is still a small piece of the whole picture, right? Because we are really talking about, like, when we talk about like banking, finance, and if you add both the spot and the derivatives markets, we are literally talking about a quadrillion in the quadrillion-dollar industry. Is much bigger than the combined economy of all countries. Finance is much bigger. So, and when you think like, oh, the size is the DeFi, if you think using market capitalization, is, it's not even $1 trillion.
1% of the market.
It's very, very tiny relative to the size, but is actually what matters here is the pace and the velocity and the speed with which it's transforming markets. And any technology starts like this, right? Like the same thing happened with the internet, a small, tiny kind of like adoption scale, but eventually the value of it started spreading out. And when it actually took velocity, it almost threw itself on its own fire. And I think that's kind of like, there's some of that stuff actually happening under the hood right now. In terms of why is, I guess, DeFi different? Is so it is based on first of all, it's based on blockchain at its basis. As its basis, it's based on blockchain technology, which essentially is a way for transactions to flow without necessarily any counterparty in the middle. DeFi on their basis are based on the fact that there are a certain set of rules, right, that you codify. So for example, let's use an example to make it clear. For example, like a lending platform that essentially defines a set of rules for one person to sell to lend onto another person without necessarily having to have legally written agreements that specifies when things happen for what reasons. That those
So,
rules are written in a application, right?
so what you're saying is like, so just unpacking what you said so far. So DeFi, the base of everything is blockchain. Blockchain, every transaction is tracked. There's no counterparty in the middle. So it's just an ecosystem that is controlling, the movement of tokens through the chain, which is secure, transparent, and there's no one in the middle fudging or being able to change or control that data. So that's thing number one. Of course, there are closed blockchains, but I'm not considering that. And then the second item that you talked about is the smart contract. So now you create an automation, which is a contract of bounding, and this is all digital. So if I say I'm gonna pay you $1,000 for every month for 6 months, once I sign digitally my smart contract, that will be part of the automation in the blockchain that will make sure that that's happening every month. So it's like a legal contract, but it's also an automation. Did I get it right?
Exactly. Yep, it is. It effectively, that's exactly the way it works. But it actually, instead, if you, the way, for example, that you would have that same relationship, kind of like in a, I guess, traditional lender, you would write paper that you say like you will pay, or else we will, for example, like a mortgage, we will foreclose on you. We will take the collateral, say your house, we'll sell that in the market, and we'll throw you out of the house, for example, right? That those are contractual kind of like relationships that you have with your, I guess, like with a traditional bank. In the case of, for example, like a DeFi system that is still based on some of the same kind of uh, like DeFi calls a lot of things kind of like by different names because it was built by people that not always worked in banking, but still the principles are there. So you would actually still take, for example, like your collateral. Let's say that you have a certain asset. Let's use the example of Bitcoin. You have a collateral. That collateral grows in value and it grows and it has volatility the same way that your house is based on the market valuation of the house. And you use that collateral that you have, that assets, as collateral to be able actually to borrow from a counterparty, right, in the system. And you say you will keep that collateral safe. So if that collateral kind of comes below a certain level, then either you're going to have to repay parts of your loan, or you're going to have, or you're going to have to put more collateral in the system to be able actually to keep your collateral. If it comes below a certain level, then the smart contract will execute the transaction and automatically, like essentially, reapplicate actually your assets and sell it into the market for people that in this case here are we call like liquidators. If we use the same analogy for, I guess, traditional banking, the analogy of mortgage, the difference here, like in each of those steps that I was just describing there, it can happen in seconds. The whole process between you putting your collateral, you borrowing against that collateral, utilizing your money for whatever reasons, you potentially gain on the water, and actually the smart contract actually the liquidation closing it on you, and you losing your assets or a portion of those assets. This can actually happen in effectively seconds. If
There
you
will be no company calling you and saying, "Hey, look, we're about to liquidate you. Is there any way, other way, that way?" It's like the smart contract, because it's automated, is just going to do the liquidation of your asset, which can be Bitcoin or Ethereum or anything that you put there. And I will ask you about something else, which is sort of the tokenization of real world assets, but we'll get into that. So it will liquidate whatever asset you have in the blockchain. That's all online. It will pay the other person that. So the smart contract never loses, because when you are in the smart contract, the automation and all the collateral are part of the ecosystem for that bit to work. And
yeah
instead of having like a paper contract, you have everything set in a way that is real and that is automated. So you can't borrow without collateral. Your collateral is there. When you borrow, if it raises below something, there will be a logic in the smart contract. So everything needs to be automated for the ecosystem to work, right?
100%. And some of these DeFi protocols, we call like DeFi protocols, some of these DeFi protocols, they have all that set of rules. And when you sign, whether like you will know some of the key, I guess, metrics that define your relationship with that smart contract and with that system. And if you breach some of those rules, or any of them, then actually that is going to happen to you. So you know that upfront. And this is where it's different. So for example, like if you use the same parallel, for example, like with mortgage. So when you go to a bank and you say like, I want to borrow, I want to borrow because I want to purchase a house. What is it that actually the bank does? So it actually takes the asset, essentially the physical house that you have, utilizes rights DAO. That's why all of them actually ask for a valuer of the house, right? Utilizes that value of the house to have an accounting mechanism within the bank that's called like a securities register. And that securities register within the bank has an accounting. This house here is worth X amount of dollars. Therefore, this person here, to have over collateralization again, for example, it's a security, has over collateralization, you, the borrower, you need to bring in a certain amount of deposits. Right? That's why you ask to bring at least 20, depends on the country, 20% deposit on that house, right? So the bank will, over the time of the loan, also be surveilling for the valuation of the house. So he gets files. So like I worked in systems, like he gets a valuation file that tells how is your, I guess, based on the index, what's the value of your house every single month. And then it will most of the time it will not necessarily foreclose you. There is a reason, because you're not in loan. But it will there will be point in time where you might say, I want to actually to top up my house, or I want to top up my loan because I want to do some new things around my house. And you look at the position at the moment of your loan to value ratio, and you will say whether you have any right actually to top up the loan, based on the fact that for you bought the house for a certain price, but since then you might have actually lost equity on it, those 20% deposit they put. So actually we do the calculation and we'll tell you whether actually we can top up or not. And if something happens, then we will foreclose. But the whole process of foreclosure, it's much slower. It's not a second foreclosure, because it needs actually to essentially enter into a legal procedure against you, because you haven't been paying your loan for a certain period of time. We try to collect from you for a certain period of time. And then at a point that actually has to throw you out, we will actually go in and have to resell the house in the market. So all of the process, the end-to-end of the process, is actually not only full of operation, but also quite costly for the bank as well to do.
So let me ask you a question, and then we come into, real world assets being tokenized. So let's say, for example, I took my house, I tokenized my house. Now I've got a token that represents my house. So it means that the ownership of my house now is that token, right? I have two questions on that, and I'll come back. So if I put my token as collateral to borrow money, for example, and then I don't pay, that can get executed. So the two questions that I'm going to ask here. Number one, if I tokenize my house, does that has a legal bounding? Like, if my token goes to someone else, automatically are they the owner of my house, or do we need to do all the papers that you would do to sell a house? And second question,
Yeah.
if I don't pay my loan and that gets executed, does that mean that my token goes and gets sold to the market? Is that what it does?
So so let me cover maybe kind of like with a bit of a disclaimer around the property side. Property and real estate is probably I believe it's going to be one of the last pieces of the market to be really tokenized.
But some people are really tokenizing houses, right?
There are experiments
And real
around it
estate. Yeah.
in real estate, but it's not like an individual property that is tokenized to the kind of like to the point that you're saying, like I have a asset and the asset has a blockchain value and actually can leverage that asset for borrowing against it. This is probably one of the longest trials that has happened in blockchain and DeFi. It has at least 7 years of people trying to do that. The problem is actually real estate. Real estate is a particularly difficult market because it's full of all of those processes, which includes a lot of legal and solicitor and a lot of humans in that loop. Therefore, it's process heavy. Um, 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 asset, and therefore I believe it's probably going to be the very last one to be
So
tokenized. There
when we
will be
talk about tokenization of
before that.
assets currently, is that more sort of um like bonds and
It's
stocks, or
it's
what
particularly
are
all the
the assets
types.
that are being tokenized today?
The vast majority now was about 99% of the assets that have been tokenized over the last few years that are on the blockchain are short-term bonds. And
Right.
the key reason is short-term US debt. The key reason for the tokenization of those assets, it comes down to one word: stable coins, right? Because stable coins are are essentially cash on blockchain, and traditional versions of stable coins essentially allow the issuer of a stable coin to have to essentially to receive fiat from what we call like a minters and deploy that fiat into what we call like a cash and cash equivalent assets, which is essentially short-term bonds and other cash management, actually market treasury instruments like repo markets and things like this. These are more like financial kind of instruments that are not like so familiar to retail activity. So bonds that are those instruments, like particularly like money market fund instruments, they have been tokenized because the stable coins have a demand for it. So actually, instead of actually the stable coin issuers going on and doing all of that process that involves the off-chain world of actually having those assets, those money market funds in a relationship with a bank custodian, they can actually abstract away that relationship with that bank custodian because the token is the representative of that relationship with the bank custodian in the same instruments, and a stable coin issuer can essentially go and acquire the bond that represents that and then issue that stable coin on the blockchain. That is the key reason why bonds have been the first frontier of tokenization.
Right.
And
So
that's
it's
where
like
you
if
can see that all of that flywheel that is happening now, that people are talking essentially on a daily basis. Oh my God, another day, stable coins are now $200 billion, another $250 billion, $270 billion, pretty much on a weekly basis. Now we are achieving kind of multi-billion-dollar kind of like growth in that market. Reverse engineers back to this. Everybody is tokenizing short-term, the most liquid debt in the world, which is actually the American US dollar debt. So 99% of the activity is happening there. There's a clear demand. There's a clear fit for the market. There's a clear demand from issuer, and there's a clear kind of like supply of tokenized bonds coming into the market. Both of them, they make a self-fulfilling prophecy. And jurisdictions around the world changing, kind of like doing a stable coin, essentially creating stablecoin frameworks. The US, the Genius Act was the last one of those that actually essentially tells the stablecoin issuers, these are the only eligible assets that you can have as backing your stablecoin as reserves. That in itself validates all of that activity that was already happening before Trump came into office. He just like put fuel on that fire. It was already, a
yeah.
lot of people already took it. instruments. It's just now every single bank as well. So like, okay, all that I have to do is actually to collateralize things and buy those instruments. Some of them might decide actually to do them directly on tokenized instruments. Some of them will continue doing actually the traditional ways of doing.
So it's interesting, like if we think about like um the whole idea of blockchain on the very early stages, and this might go down into a rabbit hole that we don't need to unpack today, but you know, the whole idea was like tokens will have its own value and Bitcoin becomes like the new gold. It has its own value and they are not backed by any fiat currency. But now with stable coins, everything is sort of getting stabilized mainly on the US dollar. So when we say stable, it's because it's stable with the value of the US dollar and not because it's stable as something that, you know, like follow, I don't know, like
Another
anything
reference,
different than that. Yeah, another
another
reference, or you
reference
know, like yeah, as the world economy is sort of degrading and a lot of um how do you
inflation
say
eating on inflation.
inflation is taking, so it's not anything like that. So we stabilize in the US dollar, which is good for America because they don't gonna lose relevancy. But then the point that I was gonna make is, okay, so you created the your stable coin in the chain, and now for you to use it, instead of taking off the chain to use it somewhere else, you're bringing other things in the chain, so you're consuming everything in the chain ecosystem, which makes
100%.
sense. That's the technology taking it over. Now if you think about
Absolutely.
banks and traditional banks, not DeFi, but what are the things that they should be looking for? What are the things that they should be starting to understand and realize? Like, why should they go in the chain? Like, what does that change in their life? Like, just, I think that's the piece that I understand the technology. I understand how it's growing. I understand all the advantages of other countries, everyone in the chain. Like, the world just becomes one place where you can change tokens in the interconnection between countries and jurisdictions and buying bonds from one or the other and having smart contracts and etc. But why do you think the banks need to get into that? Like, is there a risk that if banks don't do that, they'll lose pace? Or do you feel like everyone will go into the chain? Like, what are you seeing?
Yeah, so I think depends on when we talk about banks. I think to be precise, like, are we talking about commercial banks, so like brick and mortar commercial banks that do, for example, lending to retail? It's very different from, say, more actors that what we call, like, generically, like the shadow banking industry, hedge
Yeah,
fund,
let's talk about
bankers.
commercial
It's
banks
yeah.
to narrow it down.
So first of all, like the first thing is like commercial banks. Even though most people have a relationship with commercial banks that is based on that kind of like instruments, like a mortgage, like a loan or a deposit that he has on a bank, put on a custody, the uh, a lot of commercial banks themselves, they have treasury operations, right, that run on banks. So they engage a lot into market activity that is beyond just the business of lending your money and taking your property as security. A lot of them actually don't even actually keep that mortgage that they have against you on their balance sheets for that long. They repackage it out and they sell as like notes into the market. So there's a lot of like wholesale activity that banks are already involved in. In the vast majority of like some of those treasury activities that actually a commercial bank itself does, there are aspects of tokenization where they could really, really make significant amounts of money beyond what the returns of those of the treasury operations that they already engage in. A lot of them actually they don't see that because they haven't participated in this market. They don't necessarily kind of like know, or have actually a lot of them actually have bet for a long time that this was just a fad, that this was going to pass, that this is not, evolution of finance coming on chain, all those things. So they haven't engaged, they haven't actually taken the time actually to understand that evolution, because that revolution was built by people like myself that came from the banking background, understood some of these dynamics happening within banking, and say like, oh my God, when this thing here becomes actually scalable and and takes on its fire, it's going to disrupt a lot of those activities that wholesale banks actually do, right? So yeah. So I guess like in the short term, we can already see some glances of what might happen globally uh, in the banking world. So banks don't necessarily like so much the business of a stablecoin, right? They don't necessarily dare, because the business of a stablecoin breaks a little bit like the leverage that banks traditionally use already for their core activities, right? Because let's just kind of like take like the basics of banking here. So the basics of banking is essentially taking your money, like you have like deposits, you put deposits in your bank account. The bank essentially offers you a certificate that you have that deposit. It actually offers you a deposit service. Effectively, that's what it is. People actually say like, oh, the bank actually offers me a transaction. No. What they actually offers you is a deposit service. It takes on that deposit, and then based on certain capital requirements that it has, it leverages that deposit to lend it out into market. It doesn't actually keep that deposit in full, right? So therefore, it can actually make many more times the money that it took from your deposit to lend it out to someone else in the form of a loan. And it can leverage that by quite a bit. So it's not like one deposit from Andre becomes $1 of deposit against him. He can actually do a few times of the deposit, because he has a license to print through credit private money, right? And because it doesn't go over certain ratios that is usually stipulated by the Reserve Bank, it doesn't get into trouble, right? In times of crisis and stresses in those markets.
So just to make sure that I understood, you give me one, I lend out 2 or 3, then I get that return, and I give you back a little bit for you to give me your money so I can get more money with your money.
Effectively, and I make money as well on the difference between the interest rates that I charge on all of these other activities, my lending activities. What we call like the net interest margin is between all of the charges, like all of the interest that I get from those activities, from lending you back even money effectively through your mortgage, and what pay you for keeping your money in my deposit facility.
That's really interesting. Yeah.
And that's the way that basic commercial bank works. I mean, I'm oversimplifying, but it's not much more complex than that. The basics of a commercial bank. You can ask actually most people actually work in banking, they don't even know those basic dynamics. Actually, the vast majority, I would say 90% of like bankers don't understand actually the basic dynamic of how their bank makes money. So, but why kind of like a stable coin framework is not that interesting for a bank? Because it doesn't allow all of the operation to happen. Because a stablecoin issuer takes 100% of the deposit, puts back into a bond money market fund, and it cannot leverage on top of that $100 of deposit. It just can earn some interest on the 100. Nothing more. By statute, by legislation, it cannot do anything else. And therefore, and issues you a liability, like a deposit that says, like, here's an IOU on the deposits that I have on my bank, and now we'll attest that I always have that $100 that actually cover the $100 that I issued you as a token. So that framework is not something that is actually that appealing for a bank generally. So what is it that banks are doing? They are doing, especially JP Morgan and a few others, to jump into the blockchain. They are mimicking their same business model by creating a tokenized version of those certificates of deposit. So essentially kind of like the money that you deposit in your account that the bank can continue lending it out and doing its leverage, it is going to issue you a token that represents your deposit.
And that makes total sense, because
It
if they
makes
can create money that is backed up by something, it's like you lend me one, I lend two of my own tokens now that I'm backing up that they have value of XYZ. So if you come back with the token, I'm gonna pay you. And then they create the same narrative, but now inside the blockchain. It makes total sense. And that's what
exactly.
banks should be adapting in case there's really, I don't know how many years this is going to take, but in case the blockchain takes over, that's the way that banks will remain relevant, right?
Yeah, so they will probably not adopt so much the stable coin route because that is not interesting for them. But they will most likely not adopt the certificates of deposit routes. That's what some of the banks that have been both criticizing and operating at like saying one thing in conferences and doing another thing in the back rooms, like JP Morgan have been doing. Essentially, they are issuing certificates of deposits, which are more wholesale, but they are issuing those certificates of deposit, which are kind of similar to a stable coin in the sense that it's kind of like it's still a token, but they can continue actually doing leverage operations actually at the back. So it's kind of like it's an interesting actually evolution of the market there.
Nice. All right. I know we need to wrap up. So thank you very much for the talk, Will. For the people that listened all the way to the end of this podcast, what should they put in the comments? Pick a word. Pick a word.
Tokenized deposits.
Tokenized deposits. Two words,
If
but
you've
that's fine.
if you've heard if you listen actually to all the way to the end, so this is probably going to be a word, two words that are actually going to identify that have been here.
Yeah. Cool. Feel free to ask us questions in the comments, reach out. Lots of people have been reached out to be part of the podcast. We've been catching up with some people. We do need to organize ourselves to start bringing, to bring people for us to talk to. Yeah, but we're not gonna call this an interview. It's just gonna be a chat. So
Yeah,
anytime we find someone interesting, we'll bring as
as a
someone for
guest
us
to have a chat
as a
with
guest
us.
for us
It's
to have a chat. Yeah,
yeah.
100%. So thanks everyone for listening to our podcast. Thanks, Will. Have a great day off, I guess, or holiday, or enjoy with the family, or whatever you're gonna do, or work. And I'll see you next week.
I'll see you next week, mate.
Cheers. Bye bye.